You are listening to ChartingWealth.com's weekly review and forecast for the week beginning Monday, the 11th of January, 2016. We always jump right into IYY, which is an exchange-traded fund that tracks the entire market. Now, I've been looking at the weekly chart we typically look at, and I do not like the way that my indicators, particularly my moving average convergence divergence indicator, works on the weekly. I have found with some experimentation that my 4-day chart, so 1 day less than the weekly, seems to be a lot more accurate and a lot more helpful and a lot less sensitive to what I would call interference, that is crossing over and back quickly. So on our MACD in particular, our moving average convergence divergence indicator. So I'm going to be using for the foreseeable future until the world changes. And when do you stop using a certain chart? When it doesn't work anymore, just like we've been talking about for a few weeks since about mid-December, when our 4-hour gold chart that had been prescient, had been like so incredibly accurate in gold that I just loved it. It stopped working because gold started sliding sideways. What is the MACD not good for? Well, the moving average convergence divergence indicator, which is our favorite indicator at the bottom of our charts. If you don't have our charts, go to chartingwealth.com, sign up for our newsletter. You'll get them for free, our layout. But what's so wonderful about the MACD is it's such a great indicator, except when markets are moving sideways. It loses its ability to really give you a lot of help. But we try to team the MACD up with the derivative oscillator, which gives us some good feels, particularly when they work in conjunction with each other. When the MACD crosses and at the same time the derivative oscillator swings over, and I'm looking at a move that occurred in the market, on the total market, right around, what was that, the 19th of October. Nice simultaneous move that worked. Hey, what about recently? Nice simultaneously move on the week ending the 18th of December. The weekly chart crossed over going down, and guess what? It slid sideways for a little while and then rolled over big time at the beginning of the year, which is exactly where we start this whole thing. We are in a big, big down move. What a down week. If we break that week down into a daily chart, what do we see? Well, we see the week opening with a huge down move on Monday. And then Tuesday, up a little bit, didn't recover anywhere near what it had lost. All it was doing was digesting those losses and then pummeling down the other 3 days. Strong down moves again, already portended by our 4-day chart. We saw it coming if you look at big charts. And you look at big charts to make what? Big money. Now let's move back to our 4-day chart. And we're going to take a look at SPY. What do we see going on there? Again, that's a Standard & Poor 500. On our 4-day chart, it crossed over going down back around on the 18th again, just like the big market did. Derivative oscillator crossing over about the same time. Market slid sideways a little bit and then started moving down big time over the course of this past week, starting on the 4th. If we revert back to our daily chart, what do we see? We see very similar to what we saw in the total market. Remember, the S&P 500, 500 big companies represent a lot of the volume of the total market, but it's not exactly the same. That's why we look at both. But what do we see happening? Well, we see, again, that little burp on Tuesday where the market digested a lot of that big, strong down movement on Monday. Dead cat bounce, you might call it, and then rolled over going down Wednesday, Thursday, Friday. So confirmed down moves on the big chart, but you should have seen that coming on the big chart. It was already there, and the smaller chart. Now let's go to our last big index to look at, QQQ. What is that? It's the NASDAQ 100, the tech stocks. When did it roll over? About the same time. Nice, clean turnover with the moving average convergence divergence and the derivative oscillator about the same time. What a good move. Rolled over, and then of course we saw it continue right after the holidays. If we revert back to the daily, we see again that burp on Tuesday, the dead cat bounce, and then the market roll on over and keep trundling down. We have a blue line on our chart that represents our 2-day trend line. Of course, we're very far below that. And that is where our big three indexes are. Confirmed down moves on the big chart and on the smaller chart, the daily chart. Now, let's look at gold. What's going on with gold? Let's look at the 4-day chart and see what we see. Gold just crossed over during the course of this past week, going up at the same time, so did the derivative oscillator. So we have a confirmed up move on the big chart. And then if you look at the daily chart, what do you see? Well, you can see gold had actually crossed over on the daily chart way back on the 24th of December, going up. No, not of December, of November. But because of the sideways sliding movement, it just didn't work. That's what I talk about when I say the MACD stopped working for us on our 4-hour chart, which was prescient in gold. Why? Because gold started slipping sideways. It was bouncing off a bottom we drew on our chart in a purple line right about 104, $100.60, something like that. Bounced off of it a few times and then, of course, took off over the course of this last week. But how did it end the week? Well, it ended the week with a red candle. Why? It sort of slid sideways is what happened. The movement was totally contained within the prior day's candle, but gold could be doing just what the other markets were doing, the indexes were doing in the opposite direction, just catching its breath. And it may continue that move up this next week, or it may not. So continue to watch gold. If you're a gold bug and you're in gold, you made some good money if you got in at the right times on our 4-hour chart. So that's where we are. Those of you who listen constantly, you know that we always start our week and we end our week by looking over what happened in the last week and how it's setting us up for the following week. Well, how's it setting us up? Gold's in an up move, taking a breather. The markets, that is the total market, NASDAQ 100 and the S&P 500, big, strong down moves. All that stuff going on in China, perhaps that appears to be one of the big motivators on it. But let's delve into that a little bit. Let's talk about the week in review. What did we see going on? Well, U.S. December non-farm payrolls rose. We have unemployment rates holding steady at about 5%. That sounds okay. U.S. manufacturing sector is sputtering, though. Not so good. Service maintains its strength. What do we see with the FOMC minutes? Now, that's the Federal Open Market Committee. That's the Fed. We see the minutes came out from their December meeting about hiking cautiously the interest rate. And they did that. It was the first hike in nearly a decade. They did so with caution. Members saw the hike as a close call. They wanted to note the importance of confirming inflation will rise toward the central bank's 2% target rate. And most of the members said they were satisfied that their criteria for beginning the process of the policy normalization had been met. I guess that was before, it was before the year started off with China fizzling. What is happening in China? Well, of course, you would be hard put if you paid attention to anything going on in the market not to know that the manufacturing sector is in substantial contraction. Problems for the Chinese. It's their 10th straight month of contraction. Does that mean they're in a recession? We'll have to wait and see, of course, but could be. Now, what's going on in the Eurozone? Well, inflation's unchanged in December. U.S. auto hit record sales with cheap gas and free money. That shouldn't surprise anyone. Can you believe that pretty much anybody can roll into a dealership and for a few $100 drive out with a multi-$1,000 car? Just amazing, isn't it? China ended up suspending its equity markets, putting in circuit breakers. What did they do? Well, they just caused the markets to crash even more as people got afraid of being frozen into their positions. So just insane. But again, you got communists in charge of a stock market. What do you expect? North Korea claims to have tested hydrogen bombs. What else is new with that nutty state? And folks, let's look at what we're getting into in the new week. Well, the Eurozone industrial production data is going to be released on Wednesday at the same time, same day, the beige book from the Federal Reserve. So watch, see what the Feds say on Wednesday. Really, really good news. Could cause a bump up in the market. Might stop some of that slide if it doesn't happen before then. Then on Thursday, the European Central Bank is going to report its December meeting. Again, that could have a little bit, but really pay attention to what happens with the beige book on Wednesday. Be cognizant of that in your investing and in your trading when you're doing your virtual trades and all. Watch how that information affects the market. Okay, watch and learn from that. The United States is also going to release its sales and industrial production data. That's going to happen on Friday. Folks, that's where we are as we end the week, beginning the 4th of January, the first week of the new year. And as we enter the second week of the new year on the 11th of January. Hope this last week was good for you. Hope you saw it coming and were out and or went into an inverse fund and made some money on the downtick. Remember, beautiful thing about the stock market is you can make money when the market is going up or down if you know what you're doing. And that's what we're all about, is helping you learn, and that is practice. And we need you to tune in every day. Need you to listen to the weekly review and forecast. And we need to hear from you. I'm asking, would you do us a favor? Would you take a couple minutes, go to chartingwealth.com, tell us what you need that we're not providing you. We've got tutorials there, we've got videos, we've got our weekly podcast that we do that's the weekend review and forecast. We've got our daily reviews of the market. What are you not getting from us? What can we do extra to help you learn at an accelerated rate so that you can start doing your virtual trades, and then once you feel comfortable with that, start really trading in the marketplace? Because folks, you can sit there and watch these TV shows all day, read all the financial newspapers you want and stuff online, but if you don't get involved here and start paying attention to what's going on these charts, you're not going to know what's happening, because everything is told to you in so many ways. Not everything, nothing's everything, but so much of the information about what's going on is happening on these charts, and you can see it. That's what's so beautiful about living in this day and age. You couldn't get this information 50 years ago if you were standing on the floor of the exchange. Now you can sit here and watch minute by minute, hour by hour. You can see what's going on. And of course, that's not the way we invest. That's not the way we do our virtual trades. We want bigger charts where we can spend less time and make more money. And it comes down to you learning how it works. And that's what we're here for. Chartingwealth.com. God bless you. Hope you have a great week trading and learning. All the best.